Hey everybody, welcome to another episode of Foreclosure Help 777, where we talk about everything foreclosure related. And guys, as you know, I'm not an attorney and I don't give legal advice. I'm just a pro se homeowner who fought my own foreclosure, and I want to help as many others doing the same thing. The object is to stay in your house as long as you can and fight the bank as best you can. And if you have any questions regarding your own foreclosure, you can always send me an email to foreclosurehelp777@gmail.com, and I will try to answer your question. So today we're going to talk about predatory loans, predatory loan modifications to be exact. So let's get started. Okay, so predatory loan modifications is today's topic. We are talking about these things in great detail here. The Bible verse of the day, as you can see right here, 1 Peter 5:8. You see the line there? Be sober, be vigilant, because your adversary the devil walks around like a roaring lion, seeking whom he may devour. Okay, so it's good to know that, there's predators out there, and your bank might be one of them. There are common signs of predatory loans, the dangers, and how to protect yourself. That's what this is about, today's topic. So, predatory lending is not always obvious. It does not always begin with an outrageous interest rate or obvious fraudulent loan. Sometimes the danger appears later, when a homeowner is struggling and turns to the mortgage servicer for help. A loan modification is supposed to provide relief. It may lower the monthly payment, cure a default, or help the homeowner avoid foreclosure. But what happens when that help increases the principal balance, capitalizes questionable fees and arrears, extends the debt for decades, creates a balloon payment, or leaves the homeowner owing substantially more than before? That is why homeowners must be sober and vigilant. In this presentation, we will look at the warning signs of predatory lending, how potentially abusive loan modifications can be structured, and how to follow the money, and what documents homeowners should examine before and after signing a loan modification. The goal is simple: know what you're signing, follow the numbers, and protect your home. So, what is predatory lending? Predatory lending generally refers to unfair, deceptive, abusive, or excessively costly lending practices that benefit the lender or related parties at the borrower's expense. An unfavorable loan isn't automatically predatory, though. Common signs of a predatory loan. These people can recognize: loan flipping or repeated refinancing, excessive or unexplained fees, steering borrowers into unnecessary expensive loans, misrepresenting rates, payments, or loan terms, balloon payments or payment structures the borrower didn't understand, packing unnecessary products or changes into the loan, making a loan without reasonable regard for repayment ability where applicable, and equity stripping. Predatory lending doesn't always end at origination. This is where we introduce the central point: abusive conduct can potentially occur during servicing, default, loss mitigation, and modification as well. What is a loan modification? Let's go over that too. A legitimate loan modification is supposed to accomplish and distinguish it from refinancing, forbearance, and repayment plans. Follow the money before and after the modification. A realistic numerical example showing how a borrower can receive a lower monthly payment while owing substantially more. Fighting back. Documents, discovery, and evidence. What homeowners should obtain: complete payment history, modification agreement, modification worksheets, escrow analysis, corporate advances, fee ledger, suspense account records, servicing notes, correspondence, investor guidelines, and the foreclosure reinstatement payoff figures. That's if you get into discovery. That's what you want to ask for. So before signing, examine the entire modification, not just the new monthly payment. What was the principal balance before the modification? What will the new principal balance be? how much delinquent interest is being capitalized, and that means adding to the principal. Are attorney's fees, foreclosure costs, property inspection fees, escrow advances, or other charges being added? Has the interest rate changed? Has the maturity date been extended? Is any principal actually forgiven or merely deferred? Is there a balloon payment? Does the servicer's payment history support the amount it claims is delinquent? Can the servicer explain every dollar being added to the loan? Don't ask only, what is my new payment? Ask, what will I owe after I sign this? The payment went down, but what changed? Imagine this. Before modification, you had a $250,000 principal balance, 20 years left remaining, and $250,000 interest-bearing debt, right? Now, after modification, you have a $250,000 principal, a 40-year term, think about that, $200,000 interest-bearing balance, and a $50,000 principal forbearance. So, the borrower sees, great, my monthly payment dropped. But the questions we want to ask are, where did that $50,000 go? It may be sitting in a non-interest-bearing principal that is still owed. Under current Fannie and Freddie flex modification rules, interest doesn't accrue on qualifying principal forbearance, but that amount generally remains payable later. And what happened to my maturity date? A borrower who originally expected the mortgage to be paid off in 20 more years could receive a modification extending the modified loan as far as another 40 years from the modification effective date. Freddie Mac itself warns homeowners that although extending the term can reduce the monthly payment, they can ultimately pay more interest if the term is extended to 40 years unless the loan is refinanced or paid off sooner. A lower monthly payment does not tell you whether you received a better loan. Then, underneath, before signing a modification, compare the old loan with the new loan. What does a good loan modification look like? Well, let's take a look. The numbers are transparent. The borrower should be able to determine the old unpaid principal balance, arrears being capitalized, escrow or servicing advances, new principal balance, interest rate, new payment, new maturity date, and any deferred principal. There shouldn't be a mysterious $20,000 or $30,000 jump in principal that nobody can explain. The payment is genuinely affordable. A modification should create meaningful payment relief that the borrower can realistically maintain. For example, Fannie Mae's current flex modification waterfall targets 20% principal and interest reduction when possible. The interest rate is reasonable and clearly disclosed. The borrower should know whether the rate is fixed or adjustable and exactly what will be after modification. Current Fannie flex modifications, for example, must result in a fixed rate mortgage. Capitalized amounts are legitimate and documented. Some capitalization is perfectly normal. Fannie Mae permits certain specific terms such as accrued interest and qualifying escrow and servicing advances to be capitalized, while late charges may not be capitalized and must be waived when the borrower satisfies the trial period plan conditions. A longer term actually serves the borrower. Going from 30 to 40 years isn't automatically bad if it prevents foreclosure and produces an affordable payment. It can be a valuable relief, but the borrower needs to understand that extending the term may mean carrying the mortgage much longer. Deferred principal is clearly identified as deferred, not forgiven. This is huge. If $50,000 is moved into a non-interest bearing principal forbearance, that's potentially beneficial because interest isn't accruing on that $50,000, but the borrower must understand that the money is still owed under Fannie Mae's current flex modification rules. Forbearance principal becomes payable upon specified events such as maturity, sale or transfer, refinance, or payoff of the interest-bearing balance. So imagine that the homeowner owes $250,000 and is facing foreclosure. Here we go, a good modification. The old balance is $250,000. Documented arrears or advances plus $15,000. Modified balance $265,000. Interest-bearing balance $215,000. Deferred non-interest-bearing principal $50,000. Affordable fixed payment. Foreclosure is stopped. Every dollar is accounted for. The borrower understands when the $50,000 becomes due. Now, compare that with a red flag modification. The old balance is $250,000. The modified balance is $292,000. The borrower doesn't understand the $42,000 increase. Unexplained fees, costs are included. Terms substantially extended without clear explanation. The $50,000 is set aside, but borrower thinks that it was forgiven. Borrower focuses solely on the lower monthly payment. Let's talk about trial period plans, or TPPs. The trial period plan is essentially the test period before certain permanent modifications. For example, current Fannie Mae Flex modification rules generally require 3 trial payments for loans 31 or more days delinquent, and 4 for loans current or less than 31 days delinquent. Successful completion is supposed to lead into the permanent loan modification when the program requirements are satisfied. But here's where borrowers need to understand something surprising. Making a TPP payment doesn't necessarily mean the servicer posts it as the borrower's normal contractual monthly payment. Fannie Mae's current servicing rules provide that the qualifying trial payments that are less than the full contractual payment can be held in an unapplied suspense account until enough accumulates to constitute a full contractual payment. And Freddie Mac similarly instructs servicers to credit trial payments to an unapplied suspense account and apply them accordingly to specific rules. Okay, so I made every payment. Why does my statement say I'm delinquent? The borrower may be doing exactly what the TPP instructed while the original loan accounting still reflects delinquency. That isn't automatically misconduct, but it means the borrower needs to save every TPP letter, payment confirmation, bank statement, and monthly mortgage statement, where TPP abuse or servicing problems can arise. This is where we can discuss scenarios such as repeated requests for documents, incorrect claims that documents weren't received, improper rejection of timely trial payments, unexplained suspense account balances, incorrect calculations, modification delays while additional arrears accumulate, or a borrower completed the required trial payments and then encountering problems obtaining the promised permanent modification. And here is an especially important point for our presentation. Delays can change the ultimate numbers. Freddie Mac's current rules expressively recognize additional interest and escrow amounts can accrue during parts of the modification process and may ultimately be capitalized into the modified balance. Okay, so after you sign the loan modification, ask for, please provide me with a complete copy of the loan modification agreement executed by all required parties, and save it. Because imagine what happens 5 years later when there's another foreclosure. The servicer says the borrower defaulted under the modified loan. The borrower should be able to pull out the original note, original mortgage deed of trust, modification offer, TPP, proof of payments, borrower signed modification, fully executed modification, payment history after modification. That's the proper paper trail. But there's also an interesting twist. We shouldn't tell people that an unsigned servicer modification is always invalid. Some courts have found enforceability despite a missing servicer signature where the agreement or the parties' conduct establish acceptance. For example, a 2025 New York decision found a modification enforceable where the bank's offer had been accepted through execution, payments, and communications, and the additional signature package wasn't a condition precedent. That actually makes our lesson stronger. Read the execution clause. Who must sign? When does the agreement become effective? What conditions must occur first? And I think we have a great closing line for this. Your signature may not be the end of the modification process. Get the fully executed agreement and keep it. And discovery. Demand fully executed modification. Here's a real world example, guys. In my Pennsylvania foreclosure case, the bank relied upon a loan modification that contained my signature, but not the bank's. During discovery, the bank was unable to produce a fully executed copy. The judge recognized that the execution problem and the issue substantially delayed the foreclosure proceedings a long time. When the loan modification is not fully executed, a loan modification should be carefully reviewed to determine whether it was properly executed and became an enforceable agreement. If a purported modification is found unenforceable, the original note and mortgage may remain the operative loan documents. This can create a significant foreclosure issue if the lender attempts to calculate the default or amount due using the terms from the unenforceable modification, such as a new principal balance, capitalized arrears, interest rate, or payment schedule. Always determine which agreement the lender is actually relying on to foreclose. Now let's talk about some case law. Okay, and let's see how you pronounce this. Consignatiempo versus Bank of America in Connecticut. What makes this case especially useful is that it connects a loan modification misconduct into actual financial harm. The borrowers alleged years of delays, duplicate document demands, erroneous denials, misrepresentations, and poor handling of the modification process. When they finally received a permanent modification, the new principal included attorney's fees, default fees, foreclosure-related fees, and additional accrued interest. The Connecticut Supreme Court held that the alleged pattern was sufficient to support the CUTPA claim at the pleading stage. It characterized the allegations as involving conscious systematic departure from known standard business norms and concluded that the alleged conduct could qualify as unfair under the CUTPA, Connecticut Unfair Practices Act. Homeowner needs help, servicer delays, mishandles applications, fees and interest accumulate, modification finally offered, increased principal balance. And that is unfair. Okay guys, I hope you enjoyed today's topic, and if you have questions or comments, you can leave them below, and I will try to answer your questions. And as always, everyone have a blessed day.